Joining us now to discuss the economy and the actions the Fed has been taking, Federal Reserve Vice Chairman Richard Clarida on the CNBC Newsline. Mr. Vice Chairman, thank you so much for phoning in.
Glad to be on the show, Sarah. Hello.
Well, hello. Another day of dismal economic news and strong stock market. Why do you think the market is performing so much better than the economy right now?
Well, let's talk about the economy. And we're living through the most severe contraction in activity and surge in unemployment that we've seen in our lifetimes, and it's not a typical downturn, and that perhaps is one factor in the market. We've asked people to step back to make an investment in public health. So this is not a typical recession. It's going to be a very, very sharp contraction, certainly in the second quarter, but recovery could begin in the second half of the year, and that today is my forecast. But, what we said, Sarah, in our statement is this pandemic does pose really considerable risk to the outlook, and the course of the economy is really going to depend upon the course of the virus and the mitigation efforts. What I can say about the Fed is we're using our full range of tools, our rates, our balance sheet, forward guidance, and lending facilities to support the economy through this time, and our policies, we think, will be very important in making sure that the rebound will be as robust as possible. But, we're in for a period of some very, very, very hard and difficult data that we've just not seen for the economy in our lifetimes. That's for sure.
So are you saying, though, it's realistic to see a positive print on GDP as soon as the third quarter?
I think that's certainly in the range of possibility. Again, it's going to depend on the course of the virus. I mean, there's a range of views among economists and forecasters out there, but certainly that is one possibility. And I said that is personally my baseline forecast. That's right. But again, there is enormous uncertainty right now. And again, I'm an economist, not an epidemiologist, and I think we have to be appropriately humble as we are navigating through this period.
What about the job picture? How do you think about how high the unemployment rate is going to get, and how many of those jobs can actually come back when the economies reopen?
Well, unfortunately, the unemployment rate is going to surge to numbers that, again, we've not seen probably since the 1940s. We know that from the initial claims data that around 30 million people cumulatively have filed for claims in the last 6 weeks, and so the unemployment numbers that we'll be getting soon are really going to be very, very elevated. As I said, the course of the economy will depend on the course of the virus. There's a range of scenarios, but there can be a rebound in the economy once businesses reopen and people return to work. But I think realistically it's going to take some time for the labor market to fully recover from this shock. But that's very uncertain at this point. But I do think recovery can commence in the second half of the year.
Well, in the meantime, the Fed has been putting its measures in place, and so has the federal government. We've seen actions like PPP and other forms of economic relief. Do you think it's enough to bridge us to the reopening, to keep people on payrolls and businesses open in a meaningful way, or is there going to have to be more there from the government in terms of fiscal relief?
Let me talk first about the Fed and then a bit about fiscal policy. So as I've said, Sarah, we're using all available tools. We've cut the policy rate to zero. We've said that we're going to keep it there until we're confident the economy has weathered these events and is on track to achieve maximum employment and price stability. We're going to continue to purchase Treasury and mortgages in amounts needed to support market functioning. And as you and probably your viewers know, and since March 17th, we've announced no fewer than 9 new facilities to support the flow of credit to households and businesses. And I like your terminology. That's what we think. We think we are building a bridge with these facilities until the economy can recover by stepping in and supporting lending. And we've seen some evidence, Sarah, that just the announcement of these facilities is encouraging the private sector to lend. In particular, we've seen a lot of issuance in the corporate market. But, fiscal policy also plays an essential role. The CARES Act was absolutely essential because, the Fed has lending authority but not spending authority. So what we can do is we can lend money to companies that are solvent with the expectation that they'll be paid back, but we can't transfer income to households and firms. And obviously the CARES Act, through Paycheck Protection and unemployment benefits and other provisions, was very important to the economy. And it may well be the case, depending on how the economy evolves, that more policy support will be needed from the Fed and possibly also fiscal policy. It just depends on how this evolves.
Rich, before this particular crisis over the last 5 or 6 years, there's been a lot of analysis of how far the ECB and the Bank of Japan have gone with their monetary policy and some criticism of it as well, in part because of the decision to buy corporate bonds and even equities in Japan. How much do you regret that the Fed had to go that far this time, even if it was needed? Is it a shame that you had to go that far? Well,
I would not use those words. I think that none of us alive today have seen a circumstance like this, and under Chair Powell's leadership, the committee was united that we needed, under very unusual and very exigent circumstances, which is the language used in our legislation, that we would set up these facilities. Now, they're temporary. Indeed, all the facilities, Wilfred, that we have set up are scheduled to expire September 30th of this year in terms of new lending. Obviously, any loans we make will remain outstanding. So this is emergency authority. This is an emergency. It is emergency authority, and at the point that the economy has weathered and recovered from this, we, at the appropriate time, will scale these programs back. So it's not really a regret. It's what we need to do given the nature of the shock. And as I said, these are emergency facilities that are very timely and needed at this point and will be scaled back at the appropriate time when we're through this difficult period.
Nonetheless, do you think there's going to be a long-term impact on how market participants price risk?
Well, I think that it would be difficult in a market to forecast something like this pandemic. And again, we think this is an unusual circumstance. We can discuss more the way these facilities are set up. As you know, the Congress in the CARES Act appropriated funds to the Treasury for the specific purpose of investing in these lending facilities to support the economy through this period. So there's a lot of there's a lot of structure and legislative language behind these programs.
What about the criticism that the programs that you've designed, the 9 of them, and the action you've taken has really helped Wall Street much more than Main Street? I mean, the Fed is familiar with these. We saw it back in 08, 09. Yeah. But the fact that the market has soared while unemployment claims are also soaring, the fact that the credit markets have cleared up and companies like Carnival can now borrow, and yet people are still getting furloughed left and right, losing their jobs. How do you respond to that?
Well, I think, Sarah, the economy is going through, and as Chair Powell said the other day, this is really a heartbreaking development we're seeing with in particular in the labor market. So we're certainly aware and attuned to that. What I would say about Main Street, obviously, is supporting the economy and these new facilities, providing these programs, including the Main Street lending facility that will be launching fairly soon, and the other facilities, for example, in TALF, in which case we're going to be supporting consumer credit. Obviously, in our programs, we're buying a lot of mortgage-backed securities, and a lot of folks own homes. And so I think the broader picture is that we are providing support to Main Street, but we don't want to minimize the difficult challenge the economy faces near term. But we are providing what we think of as the appropriate support that we can now, and we're going to continue to be forceful, proactive, and aggressive until we're confident that the economy is on the road to recovery, especially for Main Street.
So you're clearly providing a lot of liquidity to a lot of different companies. What about, I mean, there are always winners and losers, right? You can't lend to insolvent companies. You can't take that much risk, junk-rated companies before this crisis. What kind of bankruptcy picture do you think is going to emerge out of this crisis in this country?
Well, I think it's just too soon to tell. I think that's going to depend upon a number of factors here. In economic downturns, there are those events. We're in a recession, and so some of that is going to be inevitable. I think our focus as policymakers is to make sure the economy recovery, when it begins, is as robust as possible. But we can't minimize that we are in a recession here, and of course, it is a global recession as well, and that's an additional factor.
How permanently scarred do you think the U.S. economy is going to be as a result of this pandemic?
Well, Sarah, I think the honest answer is I hope it's not scarred. I think that there is that risk, depending on the duration of this recession and the depth of this recession, and depending upon the contours of the recovery. I'm certainly hopeful, and certainly the Fed is doing everything that we can to minimize the amount, if any, of scarring. But again, as we've emphasized, given the nature of this shock, it's also going to be essential that fiscal policy also continue to provide support through the economy as well. And in particular, that can help to sustain the productive capacity of the economy through this period.
If we do head to another shutdown or another downturn or a second wave, as so many prominent doctors, including Dr. Fauci, says is inevitable in the fall, what else can the Federal Reserve do? You have 9 programs, you have rates at 0, open-ended QE. What other rabbits can you pull out of the hat?
Well, I don't know about rabbits, but we have a toolkit that we're deploying now, and we can deploy more as needed in the future, certainly in terms of our lending, certainly in terms of our balance sheet, and certainly in terms of our guidance. And you can be assured that we will be doing that.
Is there a limit to what the Fed can do?
Well, there is not a statutory limit. Our balance sheet is a decision that we make as a committee under the appropriate guidelines, and in particular, as I mentioned, lending against credit in the expectation that we can repay, so we can expand those lending programs as needed. You know, Congress appropriated more than $400 billion in the CARES Act to the Treasury for the specific purpose of investing in these Fed lending facilities, and only about half of that appropriation actually has been allocated now, so there is certainly more that can be done on those programs as needed.
We appreciate the time, Mr. Vice Chairman Richard Clarida. Thank you so much.
Thank you, Sarah.